Welcome back to Sense Says. Today, I'm breaking down the only 10 investing rules you'll ever need. These aren't just suggestions, they're fundamental principles. Rules that could save you thousands over your lifetime. Think of it as avoiding costly mistakes and maximizing your returns. These are the foundational principles, the bedrock upon which successful investing is built. Every beginner must know before putting a single dollar into the market. It's about starting smart and building confidence. Too many people chase hot tips, often fueled by social media hype and fleeting trends, and skip the basics, neglecting the crucial groundwork that supports long-term growth, only to get burned. This can lead to frustration and discouragement. Investing isn't gambling. It's not about luck or chance. It's a skill, built on understanding and discipline. It requires knowledge, patience, and a well-thought-out strategy. By the end, you'll have a clear roadmap to smarter, safer investing. A roadmap that will guide you towards your financial goals. Ready to build your foundation? Let's get started on this journey together. Let's dive in. First, let's talk about setting your financial roadmap. This is where you define where you want to go with your money and how you plan to get there. Think of it as the blueprint for your financial future. What are you investing for? What are the big milestones you're hoping to achieve? Is it a house, a comfortable retirement, your children's education, or something else entirely? Your goals are the compass that will shape your entire investment strategy. Be specific. How much money do you need to achieve each goal, and by when do you need it? The more precise you are, the better you can plan. Write it all down. Putting your goals in writing makes them more real and helps you stay accountable. Match your investments to your timeline. Consider how long you have to reach each goal. Short-term goals, like saving for a down payment in the next few years, need safer, more liquid assets. Long-term goals, like retirement, which is decades away, can handle more risk and potentially higher returns. Know your budget inside and out. Only invest what you can truly afford to lose without jeopardizing your financial stability. Make sure your essential bills are covered, you have a fully funded emergency savings account, and any high-interest debts are being actively handled. Paying off high-interest credit card debt is often a better investment than putting that money in the stock market, due to the guaranteed return of avoiding interest charges. This roadmap keeps you disciplined, focused, and on track towards your financial aspirations. It's especially important when markets get rough and emotions run high. Don't skip this crucial step. It's the bedrock upon which your entire investing journey will be built. With your roadmap in place, let's move on to the next key element. Next, understand risk. Every investment has it. Even cash loses value to inflation. Higher returns mean higher risk. Know your risk tolerance. How much loss can you stomach without panicking? Only invest money you can afford to lose, never your rent or emergency fund. Start small and build up as you gain confidence. Emotional decisions are the enemy. Discipline is your shield. If a loss would change your life, that money doesn't belong in the market. Protect yourself from yourself. Now let's delve into the crucial concept of building a balanced portfolio. This is where you strategically allocate your investments to manage risk and maximize potential returns. It's a cornerstone of sound financial planning. Don't put all your eggs in one basket. It's an age-old saying, but it rings true when it comes to investing. Diversify across different assets. This means spreading your investments across various asset classes. Spread your investments among stocks, which represent ownership in companies, bonds, which are essentially loans to governments or corporations, real estate, tangible assets that can provide rental income and appreciation, and maybe commodities, raw materials like gold or oil. Diversification smooths out returns and reduces risk. When one asset class is down, others may be up, helping to cushion your portfolio. For beginners, navigating the world of investments can seem daunting. Target date or life cycle funds are a great option. They automatically adjust your mix as you get older, becoming more conservative as you approach retirement. These funds make diversification simple and hands-off, perfect for those who prefer a more passive approach. If you want to keep it easy, let these funds do the heavy lifting. They handle the asset allocation and rebalancing for you. The goal: protect your money from big swings in any one area. Diversification acts as a financial safety net. Let's talk stocks, a key component of many diversified portfolios. When investing in stocks, don't let any single stock be more than 5% of your portfolio. Building a diversified stock portfolio takes time and research. Most people are better off with index funds or ETFs. An S&P 500 index fund gives you instant diversification across hundreds of companies. Passive investing, owning the whole market. beats most stock pickers over time. With just a few broad index funds, you can build a powerful, low-cost portfolio. Keep it simple, keep it diversified. That's the path to long-term wealth. Set realistic expectations. Ignore the hype. Investing isn't about 10x returns overnight. Historically, the S&P 500 returns about 7–10% per year on average, but not every year. Some years are up, some are down. Volatility is normal. Patience is your superpower. Wealth comes from staying invested through ups and downs. Chasing huge gains leads to risky bets and bad decisions. Compound interest works wonders over decades, not days. Aim for steady long-term growth. If you pick individual stocks, follow Warren Buffett's advice. Invest in what you understand. If you can't explain how a company makes money, don't buy it. Focus on industries you know. Your job or hobbies give you an edge. Look for simple, profitable businesses with a durable advantage. Avoid hype and complexity. Boring is often better. Stick to your circle of competence. That's how you make smart picks. Spot red flags before you invest. Watch for declining sales, shrinking profits, or excessive debt. High debt makes companies vulnerable. Check their balance sheet. Avoid companies with shady management or frequent scandals. If a business is too complex to understand, steer clear. Great companies are usually simple and transparent. When in doubt, walk away. There are thousands of other options. Protect your portfolio by avoiding obvious risks. Don't fall for rookie mistakes. Avoid penny stocks. They're cheap for a reason and often scams. Ignore hot tips and rumors. Always do your own research. Don't blindly follow anyone, not even me. Take ownership of your decisions. Your financial future is too important to outsource. By steering clear of penny stocks, ignoring hype, and doing your homework, you'll dodge the biggest landmines. Stay disciplined, stay skeptical. Learn from others' mistakes, not your own. Let's talk about margin. Margin trading, borrowing money to invest, can destroy beginners. It amplifies gains but also losses. A 50% drop can wipe out all your money and leave you owing more. Margin calls force you to sell at the worst time. For most people, margin is a fast track to financial ruin. Invest only your own cash until you're truly experienced. Master the basics before even thinking about leverage. Margin is for pros, not beginners. Play it safe. Avoid margin. Embrace the long-term journey. Mistakes are inevitable. Treat them as lessons, not failures. Analyze what went wrong and learn from it. Investing is a get-rich-slowly plan. Daily market moves are just noise. Compound interest needs time. Stay invested and let your money work. Don't obsess over your portfolio. Focus on consistent contributions. Dollar-cost averaging builds wealth, no matter the market. Celebrate progress, learn from setbacks, and trust the process. Your future self will thank you. That's it, the 10 core investing principles for beginners. From setting your roadmap to avoiding rookie mistakes, you now have a framework for building wealth safely. The most important step is to start. No need to be perfect or rich. Stay consistent, keep learning, and stick to your plan. Your journey to financial freedom begins now. Thanks for watching. Let me know your top takeaway in the comments.